Let us now apply our understanding on the recognitions of a provisions or otherwise a contingent liability. We have here Fact 1, where entity faces a single legal claim with a 40% likelihood of success with no cost and a 60% likelihood of failure with a cost of 1 million. What do you think we have here? A provision or a contingent liability? Yes, you guessed it correctly. For an individual event, the best estimate in this case is its most likely outcome. We are given an outcome of 40% success and 60% failure, thus need to pay 1 million ringgit. So most likely to occur is a failure with a probable outflow of 1 million ringgit. Therefore, we need to provide for this future claim, debit legal claim expense of 1 million and credit a provision for the legal claim with the same amount. When we actually make the payment, we simply utilize the provision. Thus, we debit provision for the legal claim and credit bank. What we are seeing here is a future expense is recognized now and thus will be appearing in the current financial year's income statement, thus reducing our profit in the current period, even when the legal claim has not been paid yet. Here, we're just being prudent because we already know that at this point, we will lose that much of resources from our company. And when we actually make the payment, say for example in the subsequent financial year, it will not be appearing in our income statement anymore, as it already been deducted from our profit in prior year. So that will be a relief for us and not a shock to our shareholders or whoever interested in our company. In fact number 2 here, we have a company called utility company that generates electricity. The Department of Environment has brought litigation against the utility company alleging violations of the Environmental Quality Act 1974, Clean Air Regulation 2014. Utility company expects the lawsuit to be settled in the range of 1 million to 4 million, and no one outcome is more likely than the other. Now for this case, the outflow is still uncertain, but it is in a range between 1 million to 4 million. Basically, for continuous range, we can use midpoint, in this case 2.5 million. And also, there is no outcome that is more likely than the other. Therefore, we have a possible situation here, meaning the probability that we will have a liability out of this case is possible. Therefore, we have a contingent liability. Here we have fact number 3. An entity sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within the first 6 months after purchase. If minor defects were detected in all products sold, repair costs of 1 million would result. If major defects were detected in all products sold, repair costs of 4 million would result. The entity's past experience and future expectations indicate that for the coming year, 75% of the goods sold will have no defects, 20% of the goods sold will have minor defects, and 5% of the goods sold will have major defects. So for this case, the company has already made expectations based on their experience in prior years, which is the best evidence that we can have for warranty. The obligation is not possible but already present. The moment that the company sold its product, the obligation is already present. The only thing is, we are just not sure how much the amount of liability will be in actuality. Thus, we have a present obligation with uncertain amount. Thus, we have a provision. Then, we have to provide for the amounts for the provision. We are given the forecast by the company where 75% of the goods sold have no defects, 20% of the goods sold will have minor defects, and only 5% will have major defects. So what we can do is to use this information to get to the best estimate. 20% of 1 million ringgit and 5% of 4 million ringgit gives us 400,000 ringgit. Let's try another one. For fact number 4, we have a steel mill that has an obligation at the date of installation to decommission liquid waste storage at the ends of its 30-year life in accordance with local legislative requirements. The decommissioning costs for the equipment are estimated to be 140 million ringgit. The management of the company has estimated a discount rate of 10%. The net present value of the decommissioning cost obligation was estimated at 8 million ringgit based on the 10% discount rate. The question is, how should the management recognize the estimated cost of dismantling and removing the asset and restoring the site? In this case, the installation is the obligating event that results in the decommissioning cost. Based on this situation, the resulting obligation is a present obligation, but the amount is still uncertain, since we are talking about costs in the future. The 140 million is only an estimation, therefore again, here we have a provision. The company also has calculated the present value of the estimated future cost, which is determined to be 8 million ringgit. Therefore, instead of recognizing 140 million ringgit, we need to provide for 8 million ringgit. So we debit the asset since the future cost is part of the cost of the asset. And another thing to highlight is that the rate used to estimate the present value of the future cost is at 10%. Thus we know that the value of the provision will increase throughout the 30-year period, and this is actually required by the standard in paragraph 60, where it says, where discounting is used, the carrying amount of a provision increases in each period to reflect the passage of time. This increase is recognized as borrowing costs. Having said that, we need to do adjustment to the provision every year until the end of the 30-year period. So here we have a schedule that shows every end of year there is a 10% increase in the provision until at the end of the 30-year period it will be equivalent to the earlier estimated amount of 140 million ringgit. And as for the journal entry, every end of year we will have to increase the provision, and the effect is due to the interest expense. At the end of the 30th year, when the company actually make the payment for the cost of decommissioning, we simply take that from the provision account instead of recording it as a year's expense. And to add to the issue of provision, what if the provision is expected to be reimbursed by another party? In this case, we are allowed to recognize the reimbursement when and only when it is virtually certain that we will receive the reimbursement. Otherwise, we shall not recognize the reimbursement. The reimbursement shall be treated as a separate asset, and the amounts of reimbursement recognized shall not exceed the amounts of provision, even if we may receive more than the amount of provision. When the amounts of reimbursement is actually less than the provision, we can present the provision net of the amounts recognized for reimbursement. Paragraph 59 requires that provisions be reviewed at the ends of each reporting period and adjusted to reflect the current best estimate. If it is no longer probable that an outflow of resources will be required to settle the obligation, the provision shall be reversed. Paragraph 61 reminds us that a provision shall be used only for expenditures for which the provision was originally recognized. The summary of the journal entries for provision would then be: debit the relevant expenses or asset if it's actually part of the cost of an asset, and credit provision. And where necessary, we might need to increase the amounts of provision by interest expense. When the time comes to utilize the provision, we simply need to debit provision and credit the related account, either cash or account payable, if payments have not been made yet. For reimbursement, we debit the reimbursement asset be it cash or other assets and credit expense, the net amount should be shown in the income statement and not in the provision account. The standard also highlights the future operating loss. Now, future operating loss or expected operating loss does not fit the definitions for liability and does not fulfill the general recognition criteria for provision. Thus, there shall not be any recognitions on future operating loss. However, the standard does highlight that perhaps the expected loss may be due to asset impairment, thus suggested that entity should be looking into that under MFRS 136, impairment of assets instead. The standard also touches on onerous contract, where if an entity has a contract that is onerous, the present obligations under the contract shall be recognized and measured as a provision. Now, onerous contract refers to a contract where its unavoidable cost of meeting the obligation in the contract exceeds the economic benefits expected to be received by the entity. There is a situation where at times when we cancel a contract, we are not asked to compensate the other party. For example, a routine purchase orders. When we cancel a routine purchase orders, more often than not, we are not required to compensate our supplier. In this case, we have no obligation. But in some other cases, when we cancel a contract, we could be penalized. And to exit the contract, we might need to fulfill a part of the contract that could not be avoided. So in a way, we are stuck between fulfilling the unavoidable part of the contract and having to pay penalty for not fulfilling it. The unavoidable costs under a contract reflects the least net cost of exiting from the contract. And this is equivalent to the lower of the cost of fulfilling it and any compensation or penalties arising from failure to fulfill it. An example of an onerous contract is when a lessee is still obligated to make payments under the terms of an operating lease, but is no longer using the asset, like paying rents for a house that you no longer want to live in, or otherwise you will need to pay the penalty for breaching the term of the contract. And finally, the standard also touches on the cost of restructuring. A provision for restructuring costs is recognized only when the general recognition criteria for provisions set out in paragraph 14 are met. To recognize a provision, there must be a present obligation, the outflow is probable, and the estimate can be made reliably. So there are a few things that need to be assessed before we could recognize the future costs of restructuring, which are set out in paragraph 72 to 83. Just to highlight, we need to check the obligation, as it exists, at least a constructive obligation. Paragraph 72 sets out how a constructive obligation could arise based on a detailed formal plan for the restructuring and check on whether the plan has raised valid expectation from those affected by it. If it involves a sale of an operation, the obligation only arises for the sale of an operation when an entity is committed to the sale. That means there should be a binding sale agreement. Otherwise, no obligation exists. And if the constructive obligation exists, and thus we want to recognize provision for it, we shall only include the direct expenditures arising from the restructuring, which are those that are both necessary and not associated with the ongoing activities of the entity. In terms of disclosure, you may check paragraph 84 and 85 for disclosure requirements on each class of provision. Paragraphs 86 for each class of contingent liability with more than remote possibility outflow for settlement, and paragraph 89 for contingent asset with probable inflow of economic benefit. Now, if any disclosure requirements for contingent assets and contingent liability is found to be not practicable to do so, this fact must be stated in the notes to the accounts. To summarize, If there is a present obligation that probably requires an outflow of resources, we need to recognize a provision and provide disclosure. If there is a possible or a present obligation that may but probably will not requires an outflow of resources, no provision should be recognized, but we need to do some disclosure. If there is a possible or a present obligation where the likelihood of an outflow is remote, no provision is recognized and no disclosure is required. For asset, thus inflow of economic benefits, if the inflow is virtually certain, we simply recognize an asset, as the inflow is not a contingency. If the inflow is probable but not virtually certain, no asset is recognized and we just disclose a contingent asset. If the inflow is not probable, neither asset is recognized nor any disclosure is required. So as you can see, for asset, the inflow must at least be probable for it to be at least disclosed as contingent asset, while for liability, only an obligation with a remote outflow shall be ignored. This again to ensure prudence or an entity not overestimating the amounts of asset and underestimating the amounts of liabilities. So that is all about provision, contingent liabilities, and contingent assets. Please replay this video if you think you might miss something. In our next video presentation, we will be discussing events after reporting period. So as usual, please have a read on that, and until then, thank you very much for your attention. And Assalamualaikum warahmatullahi wabarakatuh.